Gold near all-time highs. What's going on, John? I love that what's going on because it's everything. It really covers everything. So really looking forward to it.
What that means is I couldn't think of a good title for this presentation.
That's fine. That's fine. Thank you so much.
You're welcome.
Take it away.
Thank you. Earl, thank you very much for attending this session. It's a pleasure to be back in Frankfurt. It's great to be talking about gold when it's close to an all-time high. I will disagree with one fact, though. Gold didn't trade to an all-time high yesterday. COMEX futures did, but the OTC market didn't. So, and if you're interested in that sort of sarcastic, sparky conversation, then follow me on Twitter, because I take a great deal of delight in correcting people when they're wrong. It still says 0 hours, 0 minutes, so I'll have to talk very quickly. No, I'm sure they'll sort that out in a minute. Thank you, that's better. 15 minutes, okay, I should have 30. It's important, because otherwise I'll have to rush. All right, so brief introduction. My name's John Reade. I'm Chief Market Strategist at the World Gold Council. I've got 35 years experience in the gold industry, from digging it out of the ground in South Africa as an equity analyst covering gold mining companies in South Africa, commodity strategist at UBS, portfolio manager at Paulson & Company, a hedge fund, and then for the last 6 years plus at the World Gold Council. So I've been associated with the World Gold Council since they formed. We started more or less at the same time. I first came across them in about 1988, 1989. It's been around a long time, and it's done a tremendous amount in the industry, which it doesn't talk about very much. People probably know us from the gold ETF that we launched, but we have been active in many different areas. Perhaps the one I'm most proud of is the assistance that we gave to the Chinese government in 1999 and 2001 to develop the Chinese gold market. That took us from 200 tons to more than 1,000 tons of gold demand. We wrote research with their leading academic associations that guided the Chinese government into the structure of the gold market there. We've got about 32 member companies. We're owned by the gold mining companies. I say about because they keep merging and acquiring each other, and then we keep getting new gold companies come in. I was going to put a cross on here between New Cross plus Newmont, but I was told I wasn't allowed to because it does look like they're getting together. Because of our ownership structure, we're not allowed to give gold price forecasts because that would be seen to be a bit too much like OPEC. But what we do is we provide a tremendous amount of data and analysis and write research on the gold space. So today, and this is the first time we've ever done this, our presentation for gold demand trends takes place in London in about 3 hours' time. This event was supposed to be the day after that, but unfortunately we have a king that is getting crowned, and that's messed everything up. Exactly, yeah. So with all the public holidays that we have celebrating the monarchy, gold demand trends is delayed. So before the big presentation that's going to go out to all the analysts, you get to see it now. And then I'll talk a little bit about what I think is positioning in the market and things that are going on. Okay, first of all, we have a large research team around the world. We have analysts in London, in China, in India, in New York, and a couple of strategists, me and my counterpart, Joe Cavatoni. So we probably have as much assets covering gold, the metal, not mining companies, but the metal, than anybody else. This is our flagship report. Gold demand trends comes out every quarter, and it is an assessment of what's going on in the physical market. Supply, a little bit, more about demand, more about the nuts and bolts of what's been going on in terms of jewelry demand, bar and coin investment, official sector, even some comments on technology. So I'll go through the elements of this in some detail, but I'll tell you there's two big takeaways I want to take. One really positive, and that's the buying that we're seeing from central banks at the moment. Over the last 3 quarters, it has been unprecedented in its volume, and we can talk about that. The second thing I want to talk about is I was really interested to hear everybody being so positive in this room about gold, because the one number that came out of gold demand trends that really shocked me was German physical investment in gold. And it shocked me in a bad way. So we'll get on to that. Okay, I don't think we need to talk about the gold price very much. This is for the first quarter. Clearly, gold has traded higher since then. As I say, not quite as an all-time high, but it's been through 2,000 and stayed up there. I'll talk a little bit about what current drivers and what's happening a little later. Good thing is it's been strong in all currencies. This is not just about US dollar weakness. Often you will see the dollar gold price go up just because the dollar's weak. That's not happening. Gold's gone up in all currencies this year, and that's a bull market. That's a really positive sign for gold. What we do, and one of our tools on our website, and our website, by the way, is free, and I encourage you to go there, is we have this model, which is called the Gold Return Attribution Model. And it breaks down gold price performance in the red line each month, up or down, into what's been driving it. As you can imagine, last year, very much to do with risk and uncertainty in February and March because of the Russia invasion of Ukraine. So those green bars were positive. They then became negative as the fear premium from Russia and Ukraine came out of the price. The biggest drivers are almost always interest rates and the US dollar. And that's very much been the case. But what you can see happening, particularly into April, risk and uncertainties come back. Risk and uncertainties come back because of the fears of another banking crisis. So in the first quarter, we saw a big bounce back in Chinese gold demand. Nobody should be surprised by that. You will remember how the Chinese economy was locked down through 2022, and then they unlocked all in one go. We saw decent growth in jewelry demand, decent growth in bar and coin demand. On the other hand, we saw negative demand coming through, or negative demand changes coming through from India because they are so focused on the gold price. When the gold price goes up a lot, Indian jewelry demand, Indian bar and coin demand slows materially. The weakness that we're seeing in the Middle East primarily comes from the United Arab Emirates because it supplies a lot of jewelry into India as well. If you take out India and China, jewelry demand of the rest of the world is fine. So this is quarterly, and you can see it going back. You can see the impacts that we saw during COVID when people couldn't get to the shops and buy gold. You can see the bounce backs that we've seen in certain markets afterwards. But the jewelry market's okay. And I think at a gold price of $2,000 an ounce or thereabouts and record highs in most markets, that's a positive sign. This was the number that really shocked me, the really what the hell number, that when we got bar and coin demand numbers from around the world, and it comes from Germany. One of the themes we've been talking about recently is the importance of physical bar and coin demand for gold. Everybody focuses on the ETFs. Everyone focuses on changes in the ETFs because we get data on them every day, every week, and every month. But in 2022, for all the negativity about ETF flows, there was 110 tons of selling. Bar and coin demand in 2022 was 1,200 tons, and people don't speak about it very much. So one of the key themes I've been talking about has been strength in bar and coin demand, and indeed it has been okay this quarter because of China and a big bounce and a big increase in Turkey as well. But Western bar and coin demand has been really strong in the last few years, and Germany's been a massive part of that. We've seen a big fall, 73% I think it was, fall in bar and coin demand in Germany in the first quarter. Now that wasn't because Germans weren't buying gold, they were. There was quite a lot of buying going on, but there was a tremendous amount of profit taking place as well. And if you spoke to the dealers, they said, yeah, we had more buyers than sellers, but when the sellers came in, they were giving us like 100 kilos of gold in one go. I think a lot of people have been buying gold because of the very low interest rate environment in Germany. And I think now that interest rates have picked up, I think we might be seeing some profit taking and rotating out of gold from these big high net worth individuals and putting it into fixed income. So that's a trend we'll definitely keep an eye on. So talking of ETF flows, this is showing quarterly flows. Sometimes they're really important. If you go back to the global financial crisis, which would be over here somewhere, you'll see we saw some massive inflows in certain quarters and then massive outflows in 2013. Similarly, during the first quarters of COVID, we saw really strong buying coming through and then some selling. But most of the time, the flows in ETFs aren't enormous and they're not as big as we see in other components of the market. One of the questions that I've had in my mind is why we haven't seen ETF investors taking part in this rally in gold. Gold was trading about $1,600 an ounce at the beginning of November and traded nearly up to $2,000 by the end of January. And yet ETF flows were still negative month on month all the way through that process. Again, I think high interest rates offering alternatives to people that have been starved of yield may be playing a role. If you look at this on a monthly basis though, in March they flipped positive, and March they flipped positive, 32 tons of buying. April, I think it was 15 tons of buying, and month to date, okay, it's early, but we've got a few tons of net purchases. So there are signs that ETF investors have changed their behavior, probably driven by the banking crisis rather than anything else. But this is the monster number. Central bank purchases more than doubled last year to about 1,100 tons. Now, central banks on a net basis have been buying gold since the global financial crisis, and they've bought between about 250 tons and 650 tons a year. Last year, 1,100 tons. 800 tons of that was in the second half of the year. So we've seen a bit of a slowdown this quarter, 228 tons of purchases, but even so, that's the highest first quarter number we've ever seen, and up more than 200% compared to the first quarter of last year. So central banks have really changed their behavior. Who's buying? Well, with the exception of Singapore, which is now a developed market, it's emerging market countries. Emerging market countries are buying gold because they don't have very much of it as a proportion of their assets. That's been the story since 2009. Why have they accelerated their purchases? Risk and uncertainty, geopolitical tensions, and I think the sanctions that were placed upon Russia following its invasion of Ukraine. I think politicians conceptually think of central bank reserves as a part of money in a vault that they can use if they need to. And they might have a few millions of bills in there, but generally speaking, central bank reserves are invested in the treasury market, the Bund market, you name it. They're invested in those countries. And that's fine, unless you piss the Americans off, in which case you then get sanctioned and you lose access to all that money. So Russia had more than 20% of its holdings, its foreign exchange reserves, in gold, in Russia. It controls those reserves. It can sell them if it needs to. Other countries have taken note. We did see some selling during the quarter. Russia sold 3 tons, but it does that often for a coin program and then seems to buy it back about a few months later, so I ignored that. Uzbekistan and Kazakhstan are the two big ones there. They buy all of their gold from the domestic producers who have to sell it to the central bank. And they've got a lot of gold in their reserves. When they think the price is high, they often sell a bit. So I'm not reading too much into that. The other factor about central bank reserves that's interesting is central banks are supposed to report their holdings of gold to the IMF on a monthly basis. And those are the changes you can see on red. Some central banks don't report what they do, either at the time or at all in some cases. And that leads that there's a difference between our estimates of what's happening from central banks and what they're reporting. And normally it's quite small. You can see those grey bars aren't very big. Last 3 quarters it's been huge. So I get asked this question a lot. Why are the central banks not being open about what they're doing? Well, there's a couple of things I'd say there. First of all, if you're going to buy an awful lot of gold, do you want to tell people when you start? Or do you want to perhaps wait for afterwards? The second thing is as well, some of this is included in here is sovereign wealth funds. We've heard a lot of talk about sovereign wealth funds buying gold out of the Gulf because they've got lots of money because of high energy prices. So I think those are the two factors here. Interestingly, we are seeing a smaller unreported component here. But expectations, I think, are that we'll see decent central bank decent central bank purchases going forward. I've been in this market so long, I spent 20 years talking about central banks selling. I apologize, I sometimes get that one wrong. Okay, Mining companies. Not quite at an all-time high for the first quarter of the year, but it's getting close. If things carry on at this sort of rate, we will probably see 2023 hit an all-time high for gold mine production. We came close last year, off about 9 tons. But it is interesting, if you look at this chart, on a broader basis, we've seen growth, okay, over the last decade, and then stability from about 2018. I think the gold mining industry is struggling to find enough new projects to bring things online. So I'm not worried that this spike in the gold price is going to lead to enormous amounts of new production that are going to threaten the gold market. Nor am I particularly worried about recycling of old jewelry as well. In the past, back in the global financial crisis, we saw recycling explode in volumes as the gold price went up. This time around, it's been a much more muted reaction. The stock of available old, broken, inherited jewelry to come back to the market seems to be a lot less because it hasn't been that long since it was all cleaned out during the global financial crisis. And look, 3,600 tons per annum of new mine supply, 1,500 tons of, 1,200 to 1,400 tons of recycled gold. Recycling can make a huge difference, but it doesn't look like it will. Okay, I'll talk about an outlook later. So let's talk a bit what's been going on in the market. I've got 10 minutes left. Give some time for questions. This, I think, is probably the most important chart in gold. It answers the most common question I got last year. Why didn't gold go up with high inflation? Gold didn't go up with high inflation because of 2 reasons. 1, the dollar was really strong. And 2, we saw a 220 basis point, 2.2% move in real US interest rates. Previously, the biggest move we'd seen in a year was 1.6%, and gold fell 28% last year. So for gold to be flat in US dollar terms last year, I think is a sign of its underlying strength, and I'm definitely helped by that record central bank purchases. Real interest rates do matter, and one of the charts I update probably every day or every other day is what's happening with real interest rates and gold. Wall Street spent most of last year expecting gold to collapse. And they expected gold to collapse because they thought the gap between that green line and red line meant that gold should be trading closer to 1,200 where it did. This is not as important to measure this chart, but if you look at the daily moves taking place in gold and real interest rates, it does play a role. In terms of positioning, we look at the COMEX speculative positions to give us an indication of what fast money is doing in the States. A couple of things I'd say on this chart. When you see speculative positions below the line, when they're negative, close your eyes and buy gold. It doesn't happen very often. It might last a few months, maybe a quarter or 2, but they always cover, and then gold has an enormous run. You may remember the one we saw in 2019. This was when gold was trading around $1,600 an ounce last year. Okay? The other thing I'd say is when they get really big, be careful. So the good point at the moment is we're in fairly neutral territory. This is updated as of last Tuesday, so there has been a move in gold since then, but the positions are by no means excessively long. Similarly, this is the monthly change in ETFs. You can see this 10 months in a row of ETF outflows, even as the gold price started to go up from November. And you can see the little bits of positive inflows in the last few months. So the market isn't very long here either. If you held gold down to $1,600 an ounce, you're probably not going to sell it now at $2,000 an ounce. And the people that did sell it at $1,600 an ounce might buy it back. And then finally, seasonality. It's worth keeping an eye on this chart when you think about it. You often see gold have a good start to the year, and this goes back to 1971. You often have a strong end of summer, August and into September. February, March can be weak. So we've come out of the weak part part of the year. We should be in an environment now where seasonal factors won't work against you, might work in your favor. So what is going to happen this year? In the end, I think we're in a position where the Fed, as Kai said at the beginning, is coming to the end of its hiking cycle. The market's pricing that it will cut a lot this year. When the Fed cuts rates, the gold price generally does very well. That's the experience of the last 7 or 8 cycles. So that's one reason why I think you should be thinking about gold. The second thing is, as well, is the dollar, although it's not quite as strong as it was in November last year, is still strong. And if the dollar does weaken against the other major currencies, that will help gold too. What about if the Fed gets more hawkish? What if it doesn't pivot? What if it keeps interest rates higher for longer? Fine. If the Fed turns hawkish, there is probably some short-term downside risk in gold. But if the Fed stays hawkish, it probably blows its banking system up. Because we've seen that repeatedly now. The smaller, medium-sized regional banks in the States cannot cope with high interest rates because they're all long duration, and duration has underperformed. Every time there is now a sniff of deposit flight, the shares get clubbed. We're seeing that happen now with something called Pac Northwest or something. Again, they're small banks. I've rarely heard of them, and yet they're causing trouble throughout the financial system. So the Fed either cuts, which is good for gold, or causes a banking crisis, which is good for gold. It doesn't mean it's a one-way bet. If the Fed does get hawkish, that probably will trigger some profit taking. But either way, I think holding gold at the moment, despite the fact that we are very close to an all-time high, is a sensible tactical decision. We would argue, and we've got lots of research to demonstrate it for pretty much every country you can think of, and certainly including Germany, gold should be in your portfolio all the time. It helps reduce drawdowns, diversifies the portfolio, increases the risk-adjusted return of that portfolio. I'm not going to talk that argument now. That's the strategic case for gold. We make that all the time. But tactically, even though we're at an all-time high, I think we're at a relatively sweet spot. I've got 4 minutes for questions if anybody would like to ask anything. Sir?
Small cap gold stocks have been underperforming. I expect them to outperform as soon as we hit the all-time high. Since you talk to so many people, what would be, in general, is there a point where you would say that most people will recognize it's the all-time high? What would be the all-time high?
2075 is the all-time high in spot gold, according to what I can see on Bloomberg. I don't think the all-time high is actually going to trigger a change in sentiment, though, because everyone said we had hit the all-time high yesterday, and it hasn't triggered a sentiment change. So I think what you probably need to see is gold pushing through this all-time high and carrying on. If you look at a chart, and I don't have many charts, price charts in this presentation, but if you look at a chart of the dollar gold price, we've kind of been here 3 times now. And okay, whether it's an all-time high, whether it's not quite an all-time high, but if you look at a chart, we've been here about 3 times. We need to prove that we can go higher. Because evidence of the last 2 times is this is a selling opportunity. That's what a chartist would look at. So triple top, break through that, make gains, much better. Sir?
First of all, thank you for your presentation. Last year I heard some rumors that the World Gold Council will be creating a kind of gold-backed digital currency. Can you tell us something about it?
Yeah, I mean, we are investigating and progressing with a gold token, not a cryptocurrency, but a gold token that can be used as part of the clearing and settlement system of the over-the-counter market and may eventually be offered to all types of investors. It's not something that we see changing the physical nature of gold. It's not going to be an alternative, I think, for the 1,200 tons of physical bar and coin demand that we see every year. But I think it could be something that gets gold onto more platforms where people trade assets digitally. It could be a big boon to the settling and clearing of the over-the-counter market as well. So we had hopes that we'd be able to do this in a number of months. There were skeptics in the organization that said, forget about it, it'll take much longer than that, and skeptics have proven right in this case. So it's coming. We're working hard on it. I'd expect more news on that towards the end of this year or into next year. Hopefully, it will open up gold investing to a new class of investor, much as the ETFs did. Yes, sir. Egon.
Well, many of us have understood gold for a long time, and whilst most investors don't, and that includes institutional investors. And because even today we only have around 0.5% of investment gold or world financial assets. Would you say that that's, we've been standing on a soapbox for 25 years talking about gold, haven't changed the percentage. And you have also got the World Gold Council, which obviously gets a lot more ears listening to it than we do. You've done the same, but still nobody understands gold, and nobody buys gold. It's part of the fact that it really outperforms every other asset, at least in this century. So is there, sure, price will make a difference, and what's happening in the world will make a difference. We can all understand that, but do you think that we are all failing in actually explaining to the world what gold is all about?
I have 10 seconds. Never given enough time to talk about gold. Perhaps that's one of the problems. In brief, we've had a 40-year bull market in bonds, which ended a couple of years ago. We've had a 40-year bull market in equities. Okay, there's been some wobbles along the way, but you've bought equities, 60% of your portfolio, you put 40% of it in bonds, you've done really well. Yeah, you could have used some diversification, and having gold would have helped, but it wouldn't have made a massive difference, at least in people's minds. If we're in an environment now where bonds are going to be correlated to equities, which they were for a lot of the time before the last 40 years, if we're going to be in an environment where equities are going to deliver returns that are much, much lower, and if you look at the cyclically adjusted PE and its height and the expected returns that you should get from investing in equities as a consequence, we're probably going through a period of low returns. If we're going to get these low returns, if we're going to get this correlation, if we're going to see more geopolitical risk, in other words, the end of the peace dividend, other assets are going to perform poorly. It's our job at the World Gold Council, the gold industry as a whole, to make the case for gold with even more enthusiasm. And face it, throughout my career, we've been, could use a rude expression, but we've been fighting against the wind because it's just been so easy. Long bonds, long duration, long equities. You don't need a diversifier. Now, you really do. And I'm out of time. But thank you very much.